Hello, Hadi. Welcome to the show. I am very happy to have you on today.
Thank you for having me, Moshe. How are you doing today?
Doing fantastic and excited for this conversation. So let's jump right in. Can you tell us what is Asteya and who do you serve?
Yeah, absolutely. So Asteya was built a few years ago with the intention to make what we call income insurance accessible for everyone in the US. And income insurance is defined as any type of insurance that protects your income against a disability or a death, widely known in the US as either disability insurance or life insurance. The reason we've changed the name is because we wanted to focus on what the policy actually protects, and it protects your income. And we thought that the naming is doing a little bit of, how do you say, not a good, let's say, trustworthy approach to the product, because everyone who looks at disability insurance, for example, would think, hey, I'm not going to get disabled. Nothing's going to happen to me. No accident is going to occur to me. I'm sitting behind my chair. And the reality is 90% of claims happen from things not related to accidents. So they could be illness related. And the fact that the naming is disability does no good from that perspective. So we wanted to define it in a way that makes more sense for the customer. And that's where income insurance came in. And the premise is, if you go to our website or go through agents that we work with, you have the chance to buy a policy within minutes and in a reasonable manner. If you're someone who passes the underwriting process, you should be able to put your credit card, get the policy. Historically, that was a pain point because you had to go through a rigorous process of communicating with agents. The agents go through insurance companies. There's back and forth communication on documents, on medical history, on payment. So it usually used to take between 30 to 60 days, and we shrunk it down to few minutes in that case. So that's in essence Asteya and what we've tried to achieve over the past few years.
So income insurance is synonymous with disability insurance, which some people may be familiar with. Why is it so much smaller or less popular than life insurance? If I recall correctly from the statistics that I saw, life insurance is in the hundreds of billions of dollars in the US, while income insurance or disability insurance is in the single digits or low double digits.
Yeah, absolutely. That's a great question. And there's three reasons that makes this happen. Because if you think about it statistically, 4 out of 10 get disabled during their career, whereas the death rate is much lower. So in essence, logically, you should have more people buying disability versus life. And there's three reasons that we could think of, and that's what our research has validated. One is people don't know it exists. So if you do a survey around the US population, you notice like around 50% don't know what disability insurance is. They might know through their employer. If their employer does not offer this, they don't know what it is. The majority who know, you have only around 8% who have bought it. The rest either think they don't need it, as I mentioned, and that makes the demand for it much lower. So that's one. And that's more of an education process. We're not going to educate the market on our own because you're talking about 150 million people in the US, the working population that might be eligible for this. You cannot reach them all unless you have troves of money. So we are going to do that through our third-party providers, which are the agents. So when we educate the agents on the importance of this product, and they are advising their clients on an income protection gap that they might have, they would say, hey, you know what, you should consider as well this product because the statistics are not stacked in your favor. So that's one part, the education part. The second part is the distribution. So if today the mode of distribution is through agents and producers and retail brokers, if this channel doesn't want to sell it for various reasons, one of them is could be commission. Like, well, I might sell life insurance. It's easier to sell. I get an upfront payment. I will push that product. So one is their incentive. The second is the response of insurance companies. So if an insurance company, if you submit a quote and it takes them 7 days to respond, For an agent who's selling this, that means there's an opportunity cost, because now they have to wait 7 days until they get the quote, and then they close the business. So the sales cycle becomes much longer, and that it's disincentivized for them to sell it.
And the longer the sales cycle, the lower likelihood that it actually closes.
Exactly. So this distribution, which makes, I believe, around 90% of the sales in the US, 90% of insurance sales in the US are driven by these agents and brokers. If they don't push it through their funnel, then the likelihood of a customer buying it would not happen. Especially that, remember, this product is not mandatory. It's optional. It's someone who's informed and educated and understand there's an income protection gap, and they need to plug that gap in a way, or make some risk management assessment on their lifestyle. Okay, I'm 35, I have 2 kids, I'm living paycheck to paycheck. Well, if something bad happens to me, what happens? How do I pay my rent? How do I pay my medical bills? How do I pay my school allowances for my kids? So someone is doing informed decision making. They would think that this is a product that I need, and then they would go and buy it. So the fact that this product is not mandatory and you need to educate someone to buy it makes it less likely to be bought out. As compared to life insurance, we've seen a lot of banks make it mandatory when you take a loan, because if something bad happens to you, you die in that case, you have an outstanding loan. So they might make you buy a life insurance cover, but no bank would say, hey, you might need a disability. So these are the main two reasons that happen to be. One is, as I mentioned, the distribution pushing it. The second part is the education. And then finally is the complexity of the product. Disability as a product itself, if you open and read the terms, it's very complicated. There's a lot of acronyms. There's a lot of situations where you don't get paid your claim. There's like acronyms like elimination period or waiting period. There is benefit amount, benefit period. How does it trigger? How doesn't trigger? So there's an element where it becomes a little bit scary for someone buying a product that they don't know how it works. So they trust, in that case, the broker selling them their product. And if the broker, as in the second reason why they're not pushing it, if the broker is not telling you to buy it, you won't buy it. So I think these are the main three reasons that we tried to tackle. We tackled the first two, the second two, because the first one, the education, as I mentioned, takes time. The second two, one is making sure it's accessible to the producers. The commission is quite good, so they can sell it. We try to pay them within few days their commission, so they don't have to wait, or they don't have a stressed working capital. And then finally, for the customer, it's as simple as going to the website, filling the application, within 2 minutes, putting your credit card. We try to explain all the product features there, and then you would get that policy immediately. So that's a summarized answer of why there's a difference between these two lines of business.
I appreciate that. So to understand your go-to-market strategy, correct me if I'm wrong, I understand that there's three options. You can either go direct to consumer, which is kind of how Policy Genius and Lemonade went about their business model. You can go to the employer, or you can go to the agents. It sounds to me like you're doing the third, or is it a combination of all three?
So we sell only individual policies. So we go directly through the agents to an individual. We don't do group disability insurance because it's a more of a commoditized product where you have top 5 players in the market who control it. And at any point in time, if we come and create a group product, we would not be able to beat them because they're much well funded, they have a better brand. And as I mentioned, because it's a commoditized product, you cannot innovate on it. You cannot innovate on speed. No one cares in a group setting to get a policy quickly because it's through the employer. So we said to ourselves, let's focus on where we can add value in the market. And that's where the individual disability space is something that we've entered into in the past few years
through insurance agents. So can you speak to some of the nuance around what's called a B2B2C strategy, right? Because you are selling a consumer product, but through a third party business, in this case, the insurance agents.
Yeah, absolutely. So there's two business models, as you mentioned. There's direct to consumer, and then there is through agents. Both of them have advantages and disadvantages. However, if you look from an economical model, the model is as simple as you acquire a customer, you sell them a product, and then you need to retain them so that their customer lifetime value is higher than your customer acquisition cost. If you can nail that model, then you have a scalable business that you could inject more and more money into it, and then you create more shareholder value. With the D2C space, there's multiple channels you can acquire a customer, either organically, which takes a lot of time, SEO, content management. Already, if someone is more established than you, then probably you're far away from being, let's say, on the first page of Google. It probably takes years and years. So even if you do everything right, there's a low chance that you'll be on page one. Maybe you could be for specific long tail keywords, but in general, it's hard to be those that have invested like millions and millions of dollars and they've been around for tens of years. So the organic is a hard, it's a hard sell. So now you'd have to go in and acquire those customers through the paid ads, guerrilla marketing techniques, which in essence has ranged to, in my mind, somewhere between $1,000 to $5,000. That's to acquire one customer. It could be that big of a range, depending on the channels you go after. The problem is, every time you sell a policy, you get a chunk of that policy as your revenue. So if that chunk goes over that 1,000 to 5,000, you're in good terms. What happens is the level of brand trust in insurance usually is low. There's no brand loyalty. So today, if you buy a car insurance from State Farm, tomorrow, if an agent comes and says, hey, you know what, Progressive is offering you the same car insurance product, but for 20% discount. So on renewal, you would switch. And you'd see most of these ads are sometimes playing on the price. So essentially, if you've invested $2,000 or $3,000 to acquire a customer, and next year they switch, there's no way you can get that customer back unless you spend more money. So there is this lack of balance between the CAC and the customer lifetime value when it comes to the D2C. Where it might work is in either niche products where competition is not a lot and you've dominated that category. So everyone who wants to buy, let's say, workman's compensation knows that I need to go to this company because they've built that category around them. It's in the customer's mind. So even if someone else comes, the likelihood of an agent switching you is lower because they would say, what happens if that company doesn't pay a claim for my customer? Then I'm in a bad position. So this is where the switching cost goes up. But if you're selling car insurance, which is a commodity, mandatory product most of the time, you'd see the switching cost very low. So that's what's bad about the D2C space. When you go with the B2B2C space through agents, well, the customer acquisition cost technically is very, very small. What you want to acquire is that agent. You want to make sure they come and start bringing you leads. And the agent acquisition might be higher, but remember, they're sending you an influx of leads. So whatever is converting is going under that acquisition. So your partner acquisition would be recouped much faster. If tomorrow there's a switching between, let's say, customers, they're switching products that you have with the agents, you still don't lose that sale. So there's much more cash burn on the side of the D2C. It's expensive, and that's why we've seen these insurtechs that some of them went public. They've raised millions and millions, hundreds of millions, let's say. And if you look at their balance sheets and income statement, which is public, you'd see that they're still loss making, especially on the marketing and the sales side. I don't know what goes in that category, but my assumption is if you go with that model, the only way it would work is when you have less competition in this space. So if you're talking about 2 to 3 insurance companies headbutting together, maybe that would work, because eventually the customer has little choice. But if there's 25 different insurance companies, then they're essentially acquiring the same customer, and then they're bidding higher and higher. So the customer acquisition keeps going up. Google and Facebook makes the most money. Then these insurance companies tend to lose. And we've seen the trend. Everyone shifted. Everyone now is say, hey, now the agent is my friend. Because in insurance, you need to manage your CAC. And more importantly, you need someone who's closer to the customer to convince them to buy the product. And insurance is not an iPhone. It's not something that you read a review on and you're excited to buy it. It's something that is it's a regulated product. There's so many things, details in the fine print, and you need someone to assist you. And that's what's the real role of the agent. They're not just a middleman where they're getting you the lead and leaving. They're actually supposed to help the customer understand the differences between these products, which one fits their income protection gap in the case of disability insurance. So that's my 2 cents on this.
Because there's a education gap and also a trust factor there, where you're dealing with complex, also scary products, right? People don't want to think about death or disability. They don't want to think about those outcomes, and that's where the agent can help. You reminded me of an old joke. You probably heard it with regards to the VC-backed D2C businesses. The joke goes, a guy tells his friend, I know of a watch dealer that sells watches below cost. I can get you a great deal. So he asks his friend, how does he make money? He says, on volume, right? So if you're losing money in every deal, a volume doesn't really help you. But what's interesting, though, you mentioned the equation of customer acquisition cost and lifetime value. And, I don't know a ton about insurance businesses and the business model, but that parallel exists in every business that I've been involved in, whether it's B2B or B2C. If you ask me, what are the 2 most important numbers for any business, give me those 2 numbers. How much does it cost to acquire a customer, and what's the lifetime value? My question for you, in insurance, though, there's a third component which may not exist in other businesses, such as SaaS or e-commerce, et cetera. Your business model relies on the delta between premiums and benefit payouts, I guess it's called, right? So if you undercharge in your premiums by, let's say, under accounting for risk or whatever, you can get burnt on the back end, and vice versa. So how does that play into when you're modeling out, how much can I spend for a customer? Obviously, that is a core component of that lifetime value, because payout hurts lifetime value, right? And premium is the premium is what drives it. So how does that factor into that equation?
Yeah, that's an interesting question. So we're not an insurance company. We do not price the risks. We work with insurance companies that actually have actuaries that would look at historical data, and then they would price at different factors. So for example, let's take disability insurance. They would look historically, or life insurance, which is much easier because they have these mortality tables over years and data. And they would say, okay, we can pinpoint that the average age of death today is 80. And if someone has 1 or 2 risk factors, that average age goes down to 65. If someone is a smoker, that average age goes down to 50. I'm just giving an example. So they have these mortality tables out there, and they would come and look at if these factors exist. So if someone it's gender specific, it's age specific, it's health specific. They look at all of these factors, and then they would put a rate. And that rate would be how profitable, or what's the break-even point where a customer who has all of these factors, the company would collect $1 and pay out $1. Okay, so that's the essential structure of how you build the pricing. And then you come in and you say, okay, now as a company, I would like to have this much margin, I would factor in the customer acquisition cost. I would factor in the third party, let's say, third party data that I would request to do the underwriting. Like if I call in a medical database, every call is $1, for example, to get that medical records. They would factor in that price. So essentially, you've built your pricing. And then you go out, and if someone fills the application and pulls all of this information, a premium comes out, which is, let's say, $1. Now, what happens is if you want to penetrate the market share and get a cheaper product out there, you start working on these factors, reducing them and shrinking your margin. The problem is, so how do all of these companies essentially lose money? So if you look at these D2C, they've put their loss ratios publicly. And for every dollar of premium, they might be paying out $1.5 of claims. So that's not a sustainable model, because insurance doesn't work this way. Insurance should supposedly be, you put $1, you should pay out half, and then the rest goes into the pool. You reinvest it, and you have that moat, or the difference where you make money. But what happens is they would start accepting any type of risk that doesn't fit their model. So essentially, if someone is a smoker and if they have diabetes, usually an underwriter would say, reject. I don't want them. Now, if you have a risk appetite that's wider, you'd start accepting more and more of these risks. And the premise would be, because I'm a new entrant to the market, let me first build a portfolio of customers. I've acquired 1,000 customers. I've sold them only one product today. Tomorrow, I would add more and more products. Now I have access to these 1,000 people, and I try to upsell them. But the problem is, as I mentioned to you, it depends on the type of product, because the switching cost is low. There's no brand loyalty. It doesn't matter. At the end of the day, if someone gives you a discount, you might switch. So this is where there's a dance between being able to accept the right risk, which is priced rightly, and then to upsell them without losing them. This is the hard part. And I believe the companies who have mastered that, they've been around for hundreds of years. And there's a reason, because they do not acquire customers at any cost. They just acquire customers at the right cost, and they want to make sure that they're profitable. So in every dollar of premium, I'm only paying out $0.50 of claims. And that difference would allow me in economic downturns, or if a competition comes in and does price wars, to be able to sustain that damage.
So, and I appreciate you educating me on this, how these things work, because I'm just curious about, the insurance model and how these businesses make money, and how the innovation happens in an industry. Insurance is a $1.5 trillion industry, but if you look at the innovation that's happening in insurtech, that's not really changing necessarily how insurance is priced, or how it actually works. It's changing, for example, the customer acquisition channels, or how it's sold and how it's delivered, and things like that. So how can you innovate in this space when you're looking at making risk predictions that may be decades into the future, right? Because actuarial tables are based on historical data, right? And the famous line, historical performance is not indicative of future performance. Often it is, but sometimes it isn't. So for example, we had a pandemic a couple of years ago with COVID, right? How does that affect long-term mortality rates for people that were infected with COVID, or for people who got vaccinated? We don't know what that's going to look like 20, 30, 50 years from now. How does the insurance provider price that in? And how can you innovate in the actual how insurance is structured, as opposed to just how it's sold?
That's a great question. So today, if you look at all of these insurtechs that are popping up and trying to claim disruption, if you're into the industry, you would notice that there's no disruption. Actually, it's just different models of distribution practically. So you come in, you're paying a claim in 2 seconds. There's no disruption in that. It's just probably a bot who took some inputs and came up with an output. There's no disruption here. You look at, for example, embedded insurance. There's no disruption here. Essentially, it's just another way to sell the product at a point in time where the customer is doing a purchase. Like you go and buy let's say a computer online. There might be an embedded insurance of warranty. That's not disruption, right? It's just a different way of getting a sale. The disruption happens when you actually take an existing, let's say, process and doing it in a completely different way that essentially reduces the cost drastically, or it improves the efficiency and of the operation drastically as well. I think these are the two things that happen. So today, for example, where I see a lot of disruption that can be layered, it's not coming from the insurance industry, it's coming from another industry, like the AI space, the large language models. You would be able to integrate to make whoever's doing their work more efficient. So take, for example, an underwriter, right? An underwriter has like 5 or 6 steps that they need to do. They need to look at the data, they need to analyze it, they need to communicate with the client, they need to let's say run the data in their own system, and then come out with a decision. So with AI, you might be able to infuse it so that the process becomes shorter without making sure that the outcome is affected. So you don't want to be fast, but the decision is worse. So you want to make sure the decision is better. And I think to date, I have not seen any disruption. It's just a different way of marketing the changes. So fancy names, acronyms, nice looking websites. That's what's happening. But the essence, the base of what insurance is, it's taking a risk, analyzing it, and then pooling it with other risks so that essentially you're subsidizing the bad risks with the good risks. So it's a pool. 5 people would be healthy, 1 would be unhealthy. That pool of people would pay out a portion of the money out to that person, and then the rest would renew again. So I think I haven't seen any innovation to date that would be eye-popping. But I would probably in the next few years we would be able to see tools, assistive tools that would make the insurer's task easier and better, which enhances their margins and essentially would allow them to take more money and invest it back in innovation.
Yeah, I was thinking along similar lines, especially with AI, the predictive value that you would get, for example, from my Fitbit data and maybe my genome data is probably more predictive of mortality and risk than what life insurance today. They ask you your weight and do you smoke and a few other questions, and those are their factors. So I bet that there's probably better data sets and better models that can be used in the future. And I'm just curious if it's a industry thing, is it a regulation thing? What will it take to disrupt that part of the industry?
Again, it depends from which perspective you're looking at. So if you're looking from the perspective of the insurer, you're asking them to take a model that's working. So essentially, it's a model that is tried and tested over tens of years, let's say. It's working. A lot of companies are making money out of it. The model is perfect. You're telling them, come and use more recent data. So we have sleep data. We have as you said, the Aura ring that tests your activity level. You have genome data. Maybe you have active blood test data, real-time data. You might be also syncing in blood glucose monitors that gives you level of blood glucose, how it's spiking up and down, which is an indication also of long-term health. You're asking them to take this and then model it into their old system. But the problem is they do not actually have empirical evidence that what they're going to model is going to work today. So it's a step up in terms of changing how they're thinking and how the culture of insurance has already been built. So it's a huge step. It's not only about finding the data models and the techniques and implementing. It's actually changing a whole culture, a whole industry, because that has been working for a while. Everyone's making money. So unless a disruptor comes in and says, you know what, we figured out a way that actually takes the premium price lower for the same product in the market and also increases the likelihood of people staying and also reduces the loss ratio. So if you can find something that does all of these three, then now the insurance companies out there are going to be afraid, because now you have someone who's going to be able to make more money than them because they have a better loss ratio. They're going to attract more customers because they're cheaper, and people would not switch back, which means they're going to lose the customer base without being able to get them back through traditional techniques like paid acquisitions or advertising. Is that possible? I don't know. But I mean, this is where really disruption happens, when you are switching from an incumbent to a real disruptor for value, not just for fancy business model that exists, an app or, you know, an ad that sells you speed.
Exactly. And I'm confident in the innovators that we have in the audience. Hopefully somebody's thinking about this industry. So we'll see some innovation and disruption happening. Hadi, I'm getting a lot of glare on your camera with the window behind you. It's possible to shift a little bit? Much better. Thank you. Last question on this topic, and we'll come back to your growth story with the company. I noticed on your website that you offer gender neutral rates. And I was curious about that because, again, as it relates to risk factors and actuarial tables, gender or sex is a empirical data point that changes risk. So how are you able to offer those?
So we have multiple types of products. We have traditional standard products, which are gender specific in that case, because at the end of the day, we cannot make all products gender neutral. Insurance companies would not accept, just because the fact that in life insurance, for example, women pay less than men.
They live longer.
Because they live longer.
Yeah.
That's part of the actuarial table. In disability, it's the other way around. So women get disabled more than men. One of the reasons is pregnancy-related complications, which happens to increase the prices. So what we're trying to do is two things. We're trying to find products that are gender neutral. So we have one of the products there, which is not affected by gender. So that's the way we've designed it. Does not impact how the price happens. The other types of product is we look extensively at, we've done some research with few doctors, is we look extensively at the reason why someone has complications. And if those complications make sense that they wouldn't affect the product, then we still give them the rates similar than what's in the table, versus spiking up the rate just because someone ticked on the application that they had complications in the past. So we try to be somewhere in the middle. We're not going to take edge cases, but we're going to say, okay, we have to abide by standard company rates for specific products, because our vision is to make insurance accessible for everyone. And if we niche down to gender specific products, then definitely we would not be able to achieve that vision. But at the same time, we would say, okay, for people who would believe in gender neutrality, we do have a product that has certain limits that you could go out and buy out. So that's essentially how we've looked at it, so that we are somewhere in the middle.
Very interesting. I really appreciate that crash course in how insurance works and actuarial tables and all that. But let's come back to your story. You know, the title of the podcast is Product Market Fit, but of course, founder market fit is an extremely important factor as well in the success of startups. So, how did you come to found this company? What is your background, and how did that lead you to start this enterprise?
Yeah, absolutely. So I started in insurance few years ago, like around 10 years ago to be exact. And I had the privilege to work with my current co-founder on a lot of initiatives that's part of his family business. And it happened to me that I've learned the whole insurance value chain, because I was exposed to all types of insurance players in the market, from brokers, to agents, to insurance companies, even to reinsurance companies, which is the company that insures an insurance company's portfolio. And it happened that I noticed that a lot of these processes are common. There's a lot of manual, outdated systems. The way things happen in the industry is the same for the past 20, 30 years. And we thought to ourselves, that there must be a way to make it more efficient. And we've looked at multiple lines of business, and most of the lines of business were already taken, meaning that someone else has done some innovation or some different tactics to try to access the market in a better way. So we looked at disability. It was a very interesting line of business because we thought that the addressable market size, as you mentioned, is small. Technically, it's around 20 billion, not very small compared to other countries, but in the US, it's 20 billion. We see that the potential is around 100 billion for all the reasons I've mentioned earlier on: the education, the distribution, and definitely the complexity of the product. And we set ourselves this vision to go out and build first a tech stack that solves part of these pain points. We got the licenses, which took us around 2 years to be licensed in all 50 states. And then we started going after, agents and brokers to convince them to join the company. We have now around 3,000 in total. Not all of them are active, but essentially we're trying to onboard them, teach them about the different products we have, and then help them sell these products along the way. So that's a short way the story. I've been fascinated with this industry because there's a lot of room to grow, and I think the next phase is we want to bring tools for other players in the industry to be able to go digital, because we've found a way to go digital in a very easy way. Our tech stack is quite sophisticated, and we've seen that there's plenty of room for other non-digital players to first become digital and then be able to integrate with companies like us, maybe companies that are selling other products through either APIs or through having microsites or digital storefront that they could go out and sell. Remember, most of the US population have a mobile now. Everything is happening on your mobile. So if someone wants to buy, you should be able to buy on your mobile immediately. And that's important. You shouldn't be able always to call the agent, should be able to WhatsApp them, for example. They would send you a link, you would click on the link, you will fill the application, you would buy the policy. It should be as simple as this. And I think we want not only to bring income insurance, but also be someone who can push that innovation to the whole insurance industry.
Fascinating. How did your experience with your previous startup? So you co-founded Akid before Asteya. What did you take away from that experience, and how did that change your approach to the startup?
Yeah, absolutely. There's a lot of learnings that we took from there. One is it's important to know your market. You should be in a market that is well defined. It's big enough so that you also attract the right people to come and join you on this mission. And we wanted also to make sure we're in a market that if we bring a technology play into it, we can actually execute. Because if you go to a market where the insurance players are offline, well, you cannot sell the policy. Think about Policy Genius, right? You mentioned Policy Genius. Someone goes to Policy Genius, they would put their information, they will give them like 10, 15 quotes. If you want to buy one of these quotes, if that insurance company is not connected to Policy Genius, now you're offline. So you'd have to wait. And the customer say, oh, but I thought this is a digital play. I should get my policy quickly. So it's important to understand your market. And that's why we've shifted from the Akid market to the Asteya market, because that market is much mature in the US, where we can interlink with the insurance companies out there. So that's the first lesson we've learned. The second lesson is it's very important to build the right team. And fortunately for us, we built the right team in Akid, and that team has stayed with us in Asteya because they understand the market, they understand the industry, They understand the requirements that we can get from someone to build software. And that has been instrumental in the way we've hired new types of, um, let's say, job professions in Asteya. So we had the playbook and it worked for us there. We brought it here, it worked for us here as well. And finally, something that we've missed in Akid, which we've learned, and this is what I've shared with you, is the D2C play is expensive. If you want to do D2C, you either have to be very well funded or you have to be in a market that doesn't have a lot of competition so that there's not a lot of bidding happening. So that's the main learning and why we've shifted our model to be more of a B2B2C.
Got it. Did you do any market validation or customer validation with the current product that you have before building it out?
So, as I mentioned to you, we've done the market research. We had an existing, my co-founder had an existing company in the US that was selling disability insurance. So we had revenues, we had market validation. The only thing that we did not have is the digitization element. And that's what we brought from my old company to the new company, which is the digital mindset and how to take a problem and turn it into a digital solution.
Awesome. And in reaching the brokers or insurance agents as your primary distribution channel, what's been most successful in bringing them aboard, in acquiring them as your intermediaries or your representatives to sell the policies?
Yeah, that's an interesting question. So getting someone on board is challenging because one, you need to educate them on the product. You need to sell them on the company itself because the brand is new. Essentially, we've been around for a few years. So someone who has been selling insurance for 20 years, if they didn't hear about Asteya, you'd need to, sell them and sell them and sell them until they're convinced that we exist for the right reasons. And then finally, it's something to know that this is a long sales cycle. So it doesn't matter if you get a producer today, they're not going to sell tomorrow a policy. So the onboarding is different from the post onboarding, and the onboarding can take few weeks. The post onboarding can take few months until they sell their first policy. So it's essential that as you're building that flywheel where our flywheel looks like the more products we have, the more producers we can attract. And the more producer we can attract, the more customers we can sell. And then we reinvest that money into getting more products that bridge that income protection gap, irrespective of your income. Because today, if you earn $1 million, you might not find a product for you in the market. So we're trying to get all income brackets in the market. So this is where we reinvest that flywheel, more products, more producers, and then more customers. And then as the flywheel spins faster, you would see that it becomes much easier to onboard, post onboard, and then see the sales. So that has been the most challenging part. And we have a team who tries not only to onboard, but also to continuously follow up and say, okay, we haven't seen any sales. How can we help you? Is it the product? Is it the process? Is it maybe the marketing material? Is it the website? It could be any reason, right? So we try to get that partner feedback loop back in to make sure we deliver the right service to them.
Fantastic. And real quick, kind of practical question, because I'm an entrepreneur. Our audience is mostly founders and entrepreneurs. Is income protection appropriate for people who are self-employed or founders that don't have, a traditional W-2 type income?
Yeah, absolutely. So you can buy this product even if you're self-employed. As long as you're employed in some form, you have an income that's coming in, you can protect it. But if you're unemployed, there's no income coming in, then that product you probably would be declined. Because if you go there and say, hey, I'm unemployed, I want a protection of $5,000, they would say, okay, but you're not employed. So this is an income protection product. So for self-employed, absolutely. For unemployed, it's not the case.
Got it. Makes sense. Let's shift gears. I want to talk to you about podcasting. You started a podcast last year. I'm curious, why did you start and how does it affect your business, or is it just a passion project for you?
Yeah, so that's an interesting question. I actually started this last year as a challenge to myself because I'm not an English native speaker, and communication doesn't come naturally to me. So I said to myself, you know what, the best way to do it is to put yourself in a situation that is essentially a difficult situation where you're interviewing someone else and it's public. So one, you can go back and listen to it, and two, other people could give feedback, and that feedback could be in a form of more listeners. But if you have more listeners, then essentially the topic is good, you might be good, the guests might be good, it could be any of these factors, but you could figure out if it's not good at all, if it's you or the content. So I started this in August, and my intention was to do 10 or 12 episodes, because as all of these podcasters, you start this project, 90% people stop it. And I challenged myself. I said, 10, I'll record myself, I listen to myself, and then I'll see how things go. Now I've recorded, yesterday I've recorded the 85th episode. So one, I've improved. People like the content. The topic is the first 100, where I interview founders about how they've acquired the first 100 paying customers, which is for me one of the hardest, because you need that product market fit you mentioned. And I've started recently attracting more guests that are prominent in nature. uh, all guests are important for me, but as you have a podcast that's out there, and thousands of people are listening to it, you start attracting people who are, let's say, they've started their companies, they've exited, they've raised millions and millions of dollars, so the profiles start to improve. However, I like to mix and match. I like to make sure I get bootstrapped founders. I like to get people who have exited, people who have raised billions of dollars, because there's always something you can learn from everyone. The one who has $1 billion has a way to sell, and the one who's scrappy bootstrapped has a different way to sell. So there's a lot of learnings that happen from both guest types of guests. So that's the story about the first 100 that I started last year.
Yeah, I've listened to several episodes and I really enjoy it. You're doing a fantastic job. I resonate with a lot of what you said in terms of my motivation behind starting the podcast and what I've been surprised about going, along this journey. I'm an introvert by nature, and this is one of the reasons why I started the podcast, as a way to kind of practice um, uh, active listening and these kind of conversations and interviews, and developing a skill set just like any other skill set. And it's a phenomenal way to meet interesting people and learn from them. Um, you know, Hopefully the audience is learning from every interview, but I'm learning just as much, if not more, from these conversations. So really enjoying it. What's been the biggest surprise for you in this journey since you've started, either as it relates to what's been successful or not, or just about something that you didn't expect going into it, that maybe you enjoy or surprised you?
Yeah, I mean, it's a lot of hard work. Hard, it's not just about recording the session. You need to edit it. You need to promote it. You need to market it. You need to, because at the end of the day, it's not fair to the guest who you're bringing on board to share all of these insights and only five people listen to it. So it becomes an obligation that you need to make sure more and more listens happens, and that has been the hardest part, because I don't expect to make money out of it. There's no expectations from it, and that makes it less incentives for a lot of people to promote it, because if you're doing it for fun, for the hobby, if people listen to it, great, people listen to it. For me, it's an obligation. It makes a lot of sense that people who come, they need to be shared with the world, and that has been the hardest part. A lot of hard work. You need to keep promoting it. Some people would share it, some people will like it, some people will not do anything. So you have to have a thick skin of not giving up on the promotional part. But that's essentially the most challenging part. The other challenging part, which I thought was challenging, was less challenging, is preparation. And I've noticed that, because I'm getting exciting guests, and I'm eager to learn how they've done it. I'm not preparing a lot, but I'm making sure that if they are going out on other podcasts, I don't repeat the questions a lot, because no one wants to keep repeating the same answers. So I make sure to do some desktop research if they've been on podcasts, what questions have been asked. If I can ask the same question with a different angle, try to get out of that person more insights. So I've recently interviewed one of the Shark Tank judges, Matt Higgins, and he has a lot of podcasts that he has made, and I wanted to make sure, respectful of his 30 minutes, that I don't waste it on questions that he already answered. And I made sure to do an extensive research, like 3 hours on just listening to podcasts. But it isn't challenging for me. It's fun. That's the beauty about it, because you're listening, you're learning, and then you're being curious, as you said, and going out and asking more probing questions. I also enjoy a lot of guests who are maybe authors of books, because then it's not about their first 100. It's about techniques that they could share with the audience, that the audience can implement. So these are just a couple of challenges that I've faced so far.
Yeah. It's all very familiar. Do you send questions to guests beforehand?
If they ask, if they ask for them, I do. My general format is the same. I mean, I'm looking around, how have you acquired your customers, scalable, non-scalable strategies, how do you build your team, what's the most challenging part, things. I like principles a lot, so I ask a question about someone's principle, and I have a newsletter called Principles Friday, where where I research one principle from someone well known, and I share a thought-provoking question and a call to action. I do it every Friday, and I'm very principles oriented. So the more principles I could share with listeners, the better, because this is something they could apply. And I ask that question. It's just for me. It's fun. It shows how the values and the behaviors and the reactions of these guests go into the building of their business, because your principle dictates how you go out and operate, either connecting with the clients, communicating with your employees, or even selling the product. So if you're someone who's unethical, everything you're going to do in your business is going to be in that front. But if you're someone who believes in the principle of hardworking, then you would see along the way that they are respecting their employees, their customers, and even their investors. So these are just some ways of how I enjoy asking questions.
Got it. Last question for you on this topic. With regards to the episodes that are most successful in terms of reach, what have you found to be predictive of that? Is it the kind of celebrity status of the guest? Is it promotion of the guest or your promotion? Which episodes tend to stand out?
Yeah, actually, it's not about the name, to be frank. What happens is, the more engagement there is, both from the audience that is responding to where I'm posting, the higher the listens, and then more importantly, the how much effort the guest is putting into resharing that episode with their listens. We see a lot of uptick. So if someone, you know, I put it, let's say, a video on LinkedIn promoting it, and there's no reaction from the guest, the chances that the listens come in are much lower than if they engage. So it's not always about the name, it's not always about the name. It's more about how engaged they are, and how much the audience is reacting to the topics of the episode.
Yeah. And how do you encourage the guest um, to do that sharing and promotion? Do you remind them to do it? Do you give them scripts or like sample text to share, or you just kind of hope that they're going to do it?
No, so I don't do any scripts to them. I mean, everyone has their own voice, but I do send a reminder on when the episode goes out. I do send quarterly reminders to, go up and try to push their episode. I try to have some milestones. So every 50th episode, I go back and try to ask people to, push their episode again to their listener base, so people could be reminded about all the value that they've given there. So I try to have these milestones that probably I'm not doing the right job, but again, as I told you, the idea is I'm having fun. I hope people listen to it if there's value in the podcast.
I think you're doing a fantastic job, and I'm going to continue listening because the few that I listened to were really good. So keep that up, and thank you for sharing. This is very self-serving. Hopefully, someone in the audience gets value out of this, but this is just for me to learn. Let's close out. We're running out of time here, Hadi. I really appreciate your time. So we like to end with a exciting lightning round. What's a book, podcast, or newsletter, besides for your own, that you find yourself recommending most often?
So I'm a big podcast listeners. I think so far I have like 8,000 hours of podcast listened to. So I do have a bunch that I always go back to from. So business oriented, I look at, Twist, Angel. It's Jason Calacanis. I think how his
Yeah. This Week in Startups with Jason Calacanis and
yes.
Molly Wood. Yep.
Exactly. So I listen to that. He brings interesting guests. I listen to How I Built It with Guy Raz. Very interesting way of telling stories. I listen to Reid Hoffman, Masters of Scale. So these are like the top podcast, business podcast. And on more of health related podcasts, there is one that's called Bulletproof Coffee, and then there's Dr. Gundry, Dr. Hyman. These are like interesting biology / hack podcast.
Mm-hmm.
So I could name a lot. On the newsletter, actually, I'm not very big on a lot of the newsletters, although I'm subscribed to, sorry, a recent one on AI called Zane newsletter. And then on news, I have Finemize. I don't know if you're familiar with that. I have also on business, I have one called Robinhood Snacks,
Mm-hmm.
which I always listen to. They do snack bites information. And then on book, I would recommend Awaken the Giant by Tony Robbins, because he's been an idol to me. I've went to his seminars, very transformational, especially the one with Walking on Fire. So I always recommend his books. It's a little bit theoretical, but if you embrace the learnings and then you apply them, you notice that they're more practical than theoretical. So this is a small summary.
Yeah, I appreciate that. What, out of curiosity, I'm shocked by how many. I thought I listened to a lot of podcasts, so I think you have me beat. What player do you use?
Actually, I'm using currently Spotify, but I do 2x the speed so that I can consume more, because I have like 70 podcasts that is I'm subscribed to. So essentially, I'm missing a lot of episodes now because I don't have time to listen all of them. So I try to do 2x, and you'd notice that when someone's listening to 1.25x or 1.5x, they become annoyed with it, because I don't realize it anymore. It becomes second nature when someone is speaking very fast now. I can comprehend what they're saying because I'm trained over a few years. But if someone's sitting with me in the car and I put the podcast at 1.5x, they would say, why is that person speaking so fast? Can you slow it down? So I don't realize now that it's fast, but that's how I consume a lot of podcasts.
I hope nobody in the audience is listening to my terrible voice at 1x. Please speed it up. I am always at 1.5, 1.75 for sure.
Exactly.
If you could have coffee with any historical figure, who would you choose?
That's an interesting question. I like a lot the physicist Richard Feynman. And I'm not into physics, but I'm into logical thinking. And I like how he breaks things into easy, digestible content. There's few YouTube videos for him out there where he's explaining physics principles. But the fact that it's very interesting for me to sit with someone who has frameworks, because what you inherit from these people, it's not the data or the information they're giving you, but the frameworks and strategies and tactics that you can go out and deploy them in other instances. And that's what I like. I like to. I never had a mentor, and the only mentors that I had are books. So if I had the chance to go back and said, I want to learn how people think, how people decipher information, and that's what I like to teach tomorrow. Maybe my children is frameworks of thinking rather than the data or the information and the thinking itself.
Absolutely. Uh, what's a piece of terrible advice that you've received in your career?
Well, that's hard to that's hard to tell, because what happens is when someone gives you an advice that's terrible, you tend to forget it. You don't want to keep it with you. And I think most of the advice that are terrible are coming from my parents, because what happens is now that I have a child, what happens is when you give your child an advice, you want them to be, the first thing you want to make sure is you want to be safe. They want to make sure they're safe. So you give them bad advice so that they don't attempt to do it, so that they stay safe. So a lot of the advice that my mom gave me early on, and now I'm thinking about it, was bad, especially on food. What I should eat, what I shouldn't eat, was bad advice. So now, as I learn about diets and the importance of how to take care of your body, I go back and say, you know what, all of these advice that my mom gave me was bad, but I don't blame them, right? It is what they know, it is what they think is right, and that's what I appreciate, the effort they've done to do that. But that's definitely terrible advice. I would try to avoid giving my children.
Trying to protect them by giving them the safe
The
advice.
safer advice, yeah.
Fair enough. Last one. I know that principles are important to you. You've mentioned earlier. What are the principles that you live your life by?
Well, one of the principles that I like is always be curious, because essentially, when we grow up, you notice that we ask questions. Children ask questions. Why is that? Why? And we lose that. We become complacent. We become lazy. We become uh, people who are accustomed to the norms in the society. We lose that curiosity element. And the only way you can solve problems and to add value to the society is to be curious, because if something doesn't make sense, or if something is broken, then you need to ask why, and then you need to fix it. So I think the curiosity element is something we lose as we age. And I try to remind myself, always be curious, always try to think about things from first principles, think about why someone is doing a certain thing, even question your own beliefs and principles, because certain things might work in a context, but they change in different contexts. And you shouldn't be only abiding by it because it used to work in the past. And I think that's an important principle I live by. Even in business, I try to be always curious, ask questions, dive into, I call them the five whys, which are common. Why? And then, you get to, you would notice that sometimes what you thought is right is not right. So that's a principle that I love and I keep close to my heart.
I love that. Have you read the book Curious Mind by Brian Grazer?
No, that's an interesting thing. I write down and try it.
Yeah, check that one out. I agree. I think the curiosity is so important. One of the main values that I try to instill in my kids as well. Hadi, I can keep going, but we're out of time. I really, really appreciate this. How can people connect with you to continue the conversation? Please remind us the name of your podcast and your newsletter, and also any final words of advice for the audience.
Thank you for having me. That was an amazing episode. I hope I added value to your listeners. If people want to reach out to me specifically, I'm on LinkedIn, Hadi Radwan. Probably I'm the only one with that name. You can email me as well. I have my email there. Then, if you want to support me, you can listen to my podcast, which is the first 100. It's on all platforms. And if you're interested in principles, my newsletter is called Principles Friday. I can share the link with you. It's on Substack. And finally, if you're interested in income insurance, you can go to our website, asteya.world, asteya.world, and you could start an application. We have a support team that could help you in getting your income protected.
I'm going to put all of those links in the show notes. Thank you, Hadi. Wishing you all the best and hope to stay in touch.
Thank you, and have a great evening.